Have you ever stopped to think about what really holds our global financial system together? I mean, it feels so stable most of the time.
It does, doesn't it? But, for decades, the answer has pretty clearly been the U.S. dollar. It's been the anchor.
The world's reserve currency. But that position, it's not guaranteed forever, is it?
No, absolutely not. It's a product of history, American economic might, and, crucially, international agreement, or at least acceptance. And that acceptance is, well, it's shifting.
Exactly. And that shift is really what brings us to our deep dive today. We're going to dig into the future of this whole system, specifically looking at the Trump administration's plans to keep America's economic power intact.
Right. And we're drawing on some key sources here, a report by Stephen Mayan from November 2024, right after the election, and then a follow-up speech he gave at the Hudson Institute in April 2025.
So our mission, if you will, is to really understand that strategy. What are they trying to achieve? How do they plan to keep the dollar on top?
And, importantly, what could the fallout be? Especially with all this talk about de-dollarization and the rise of groups like BRICS.
We know you want to get the key insights fast without wading through everything. So we'll pull out the most crucial bits, the surprising angles, and try to make sense of it all.
Okay, let's get started. At the core of this is Trump's own view on the dollar. He's been pretty clear, hasn't he?
Oh, absolutely. Keeping the dollar as the world's reserve currency is like a central piece of his economic thinking.
And he wasn't shy about it during the 2024 campaign.
Yeah.
He made some pretty strong threats against any country looking for dollar alternatives.
Yeah, I remember the talk about potentially slapping 100% tariffs on countries trying to ditch the dollar. Well, that's playing hardball.
It really is. It showed how serious he was, and his language matched it. He said the dollar was under major siege.
Right, and he vowed that under him, no country would be allowed to leave it. That's quite a statement.
It really underlines his commitment or maybe determination on this issue.
So while the U.S. is digging in its heels, this de-dollarization trend, it's not just talk, is it? There's actual movement happening.
No, it's real. The numbers show it. If you look at global central bank reserves, the dollar's share has definitely slipped.
What are the figures?
Well, back in 2000, it was over 70%. Now, it's sitting under 58%, and the trend line is pointing downwards.
Wow, that's a pretty significant drop over 2 decades. So what are they buying instead? Gold?
Gold's a big part of it, yeah. Especially since the 2008-2009 financial crisis, which, let's remember, started in the U.S. Central banks, particularly in the Global South and countries linked to BRICS, have been noticeably increasing their gold holdings. It's seen as, a safe haven, something not tied to one country's policies.
Okay, BRICS. That's Brazil, Russia, India, China, South Africa. They seem to be gaining momentum as a group.
They are. They officially formed back in 2009. And it wasn't a coincidence that it was right after that U.S. financial crisis.
So it was partly a reaction to that.
You could definitely say that. It highlighted the risks, or perceived risks, of relying so heavily on one currency, one economy.
And how does Trump view BRICS? I get the feeling not very warmly.
That's putting it mildly. He definitely sees BRICS as a challenge, a threat to U.S. dominance. He even claimed, falsely, that his tariff threats had killed it off.
Right, I remember that.
Yeah, he often talks about it being formed for a bad purpose. It shows his very confrontational approach.
So it sounds like tariffs are really the weapon of choice here in his economic arsenal.
Absolutely. He sees them as leverage. Threaten to cut off access to the huge U.S. market, and you can force other countries to, toe the line economically and politically.
It's quite something, isn't it? The U.S. trying to remake the global financial system.
The very system it largely created back in 1944 at Bretton Woods.
Exactly. That historical context is fascinating. Tell us a bit more about Bretton Woods.
Okay, so picture this. World War II is ending. The U.S. calls its allies together. They need a new financial order. 2 main ideas emerge.
Keynes was involved, right, with his Bancor idea.
Spot on. John Maynard Keynes, the famous British economist, he proposed this neutral reserve asset, the Bancor. Its value would be linked to a basket of global commodities.
The idea being?
To avoid any single country having that exorbitant privilege, as it's called, of printing the world's money. A more level playing field.
But the U.S., represented by Harry Dexter White from the Treasury, had other plans.
They did. They pushed for a system built around the U.S. dollar. Other currencies would be pegged to it. And the dollar itself was supposed to be backed by gold, at least initially.
And that exorbitant privilege that gave the U.S. a massive advantage.
Oh, fundamentally. After WWII, with Europe and Japan devastated, the U.S. economy was dominant. Putting the dollar at the center cemented that power globally.
Until 1971, the Nixon shock, when the U.S. went off the gold standard, that must have sent ripples everywhere.
Huge ripples. A watershed moment. Nixon cut the tie between the dollar and gold. And then, crucially, the U.S. struck a deal with Saudi Arabia.
The petrodollar deal.
Exactly. The U.S. offered security guarantees. And in return, the Saudis agreed to price all their oil exports in U.S. dollars.
So suddenly, everyone needed dollars to buy oil, which everyone needed.
Precisely. It created this massive, ongoing global demand for dollars, even without the gold backing.
And U.S. Treasury bonds, U.S. government debt, effectively replaced gold as the core asset backing the system.
That's basically what happened. U.S. Treasuries became the primary reserve asset globally. And this shift, it arguably fueled the financialization of the U.S. economy.
Meaning more focus on finance than making things.
Kind of, yeah. And some argue it contributed to deindustrialization. The U.S. became, in effect, the world's banker. By 2024, the U.S. stock market was like over 60% of the entire global market cap. Foreign investors just get pouring money into dollar assets.
It sounds like a pretty sweet deal for the U.S. on the face of it.
To certain parts of the U.S. economy, absolutely. And our sources do mention the significant number of billionaires in the Trump administration benefiting from this system. But despite those benefits, Trump himself sees major problems.
Okay, what are his main complaints?
Two big ones. First, the decline of American manufacturing, the deindustrialization we mentioned. He sees that as a huge loss.
And the second?
The fact that the U.S. consistently runs a current account deficit, buying more from the world than it sells.
Right. And that's kind of necessary to supply the world with dollars, isn't it, if the dollar is the reserve currency?
It often is, yeah. That deficit helps pump dollars out into the global system. But Trump sees that deficit as a sign of weakness, something unsustainable.
Okay, so those are the problems he sees. What's the proposed fix? This brings us back to Stephen Mayen and this idea of a Mar-a-Lago Accord.
Right. So Mayen, Trump's advisor, laid this out in that November 2024 report and the April 2025 speech. His core argument is that the dollar is persistently overvalued.
Too strong, basically.
Yes. And he says this is because of inelastic demand for U.S. reserve assets.
Inelastic demand, meaning the world just keeps buying U.S. assets like treasuries and stocks almost no matter what?
Pretty much. Yeah. Because the dollar is the reserve currency, countries pile up dollar reserves. They don't want them just sitting there losing value, so they invest them, mostly in the U.S. financial system. Mayen argues this constant buying pressure keeps the dollar artificially high.
And a strong dollar makes U.S. exports expensive, hurting manufacturing.
Got it. So how does Mayen propose to fix that?
Well, his words were quite blunt. He said the plan is to get other countries to subsidize the U.S. empire.
Subsidize the U.S. empire? Wow. How?
He listed 5 main ways. First, other countries should just accept U.S. tariffs and not retaliate. The money goes straight to the U.S. Treasury.
Okay. What else?
Second, open up their markets more, buy more American stuff. Third, spend more on defense and buy American military gear.
2 more.
Fourth, invest in the U.S., build factories here. And fifth, the most direct one, just write checks to the U.S. Treasury.
Just write checks, like tribute payments.
It certainly has that feel. He even floated the idea of pressuring countries to buy really long-term U.S. debt, like 100-year bonds, at super low interest rates. Which means, with inflation, they'd effectively be paying the U.S. to hold its debt.
Exactly. A subsidy, as he puts it.
And this whole package, using tariffs as a threat to force these kinds of concessions, that's the Mar-a-Lago Accord idea.
That's the informal name people are using, yeah. The twin goals seem to be protecting U.S. manufacturing and keeping the dollar as the reserve currency. It's kind of trying to have your cake and eat it, too.
People compare it to the Plaza Accord in 1985.
They do. Back then, the Reagan administration got allies like Japan and Germany to agree to strengthen their currencies against the dollar, making U.S. exports cheaper.
But the world's different now, isn't it? Especially with China being such a huge player. Can that even work today?
That's the big question. There's a lot of skepticism. The U.S. isn't as dominant economically as it was in '85, and China is definitely not 1980s Japan. They're unlikely to just roll over.
Right. And people are worried this could seriously blow back on the U.S., aren't they? Even some Trump supporters.
Oh, definitely. Take Bill Ackman, the billionaire hedge fund guy. He supports Trump. But he warned these tariffs could ignite an economic nuclear war.
Economic nuclear war. Strong words.
Yeah, leading to a self-induced economic nuclear winter. That gives you a sense of the potential downside people are seeing.
And it seems pretty clear that China is seen as the main target here.
Mayen couldn't be clearer about that. He calls China the main adversary. The tariffs are designed to hit China hard, weaken it, force companies to move supply chains elsewhere.
He even blamed China for the 2008 crisis, which is a unique take.
It's highly controversial, yeah. Most economists point to U.S. subprime mortgages and financial deregulation. Mayan argued China buying U.S. mortgage debt fueled the bubble. It's not the standard explanation, let's say.
And these tariffs on China could get incredibly high, like 104%.
That's the potential peak if China retaliates fully against the initial proposed hikes. Yeah, 104%. One economist, Brad Setzer, compared the potential impact to a massive oil price shock.
Like oil jumping $100 a barrel, that would cause chaos.
Absolutely. Huge inflation, major economic disruption. Mayan himself calls it an economic game of chicken.
Right. And he cited some research suggesting the U.S. might win a trade war.
He did, a 2024 paper.
Uh-huh.
But here's the catch.
There's always a catch.
Well, the paper's conclusion specifically said the gains for the U.S. in a trade war with China would likely be minimal because the trade imbalance is just so massive. So it seems like a huge gamble for potentially very little reward, according to their own cited source.
And Mayan believes the U.S. has the upper hand because China needs American consumers.
That was his argument in the Q&A after his speech. He thinks China's economy is built around selling to the U.S. The U.S. can just buy from somewhere else, but China can't easily replace those American buyers.
A confident stance. But what is China saying?
Well, they're not exactly backing down. Their Commerce Ministry basically said they'd fight to the end.
Fight to the end.
Yep. They called the U.S. tariff threats unilateral bullying and said they're ready to defend their interests. No winners in a trade war is their line.
And there's growing evidence that maybe the U.S. is actually more dependent on China in some ways, isn't there?
There is. That 2024 Swiss study concluded exactly that, pointing to U.S. reliance on Chinese industrial components. And China itself is becoming less dependent on exports overall.
Right. The share of exports in their GDP has fallen quite a bit.
Dramatically.
Yeah.
From around 36% in 2006 down to under 20% now. Domestic demand is much more important for them. And look who their top trading partner is now.
Not the U.S. anymore.
Nope. It's ASEAN, the Southeast Asian nations.
Wow. That shows how trade patterns are shifting.
Definitely. Countries like Indonesia, huge economy, now in BRICS, are becoming way more important for China. And China's the top trading partner for, like, over 100 countries now.
Plus, their trade with Russia has surged, right?
Hugely. Especially in the last few years. China's Russia's #1 trading partner by far now. It just shows there are alternatives out there, other markets, other partners.
So Mayan's idea that it's easier for the U.S. to rebuild factories than for China to boost its own consumer spending, that sounds questionable.
Extremely questionable. Reindustrializing is a massive long-term project. Infrastructure, skills, investment. It takes years, decades even.
Whereas China can stimulate demand relatively quickly.
They have the tools, yeah. Government spending, infrastructure projects, social programs, they can turn that tap on much faster than the U.S. can rebuild its entire industrial base.
Which means at the end of the day, who probably pays for these tariffs?
American consumers, most likely.
Right.
Through higher prices. That Stanford study estimated disposable income could fall 4% for poorer households, 3% for the middle class.
That's like a hidden tax increase, especially while they're talking about cutting taxes elsewhere. And there are contradictions in their goals too, right? Dollar value, interest rates.
Big time. They want a weaker dollar for exports, but tariffs could cause inflation, potentially strengthening the dollar or forcing the Fed to raise rates. They want lower treasury yields because the national debt is huge.
Right, the interest payments are getting massive.
Exactly. But tariffs risk causing inflation, which pushes yields up. The only way they might get yields down is by causing a recession, which is hardly ideal.
It sounds like a policy minefield. And are we already seeing international pushback? Boycotts?
There are reports, yeah. Boycotts of brands like Tesla in parts of Europe, some noise out of Canada too. It suggests foreign consumers might not be on board with this approach.
Okay, so back to that Plaza Accord comparison one last time. It's really not the same situation, is it?
Not at all. The countries pressured back then were U.S. allies, almost vassal states in some cases, with U.S. troops stationed there. And their economies were much smaller relative to the U.S.
China is a totally different beast, and they probably remember what happened to Japan after the Plaza Accord.
You bet they do. Japan's economy arguably never fully recovered from the asset bubble that followed. China will have studied that very carefully. They're extremely unlikely to agree to anything similar.
So the risk here is really one of, well, overconfidence, miscalculation.
You could call it imperial hubris, maybe, underestimating other countries' ability and willingness to find alternatives if pushed too hard. This whole strategy might actually speed up the move away from U.S. dominance and strengthen groups like BRICS.
Okay, so wrapping up this deep dive. The core tension seems to be the Trump administration's push to maintain U.S. financial power using some pretty aggressive tools.
Clashing with this changing global landscape where other powers are rising and looking for, different arrangements.
And the risks, the potential unintended consequences for everyone, including the U.S., seem really significant.
They really do. This could reshape the global financial order, but maybe not in the way the administration intends.
It definitely leaves you thinking, what would a truly multipolar financial world actually look like? And where would the U.S. dollar fit into that? That's something to chew on.
For sure. It's a story that's still unfolding, and the next few years could be quite dramatic.
Absolutely. And if you found this useful and want to keep track of these big economic shifts with us, please do hit that like button and subscribe to our YouTube channel. We'll keep digging into these crucial topics.